It's a good time to check in with a former Fed official to get a sense of how the Fed deals with the pressures of slower growth, rising prices, and the limits of monetary policy. Joining us right now to talk about it, Al Broaddus. He's the former president of the Richmond Fed. Al, always good to have you here on Street Smart. The Fed.
Here, Carol.
Well, the Fed, Ben Bernanke, we heard from him this week. He talked about the economy. No new surprises, but I'm curious. You've been inside the Fed. What do you think is troubling them the most at this point? Where are they having the most discussions?
Well, I expect, Carol, if they're concerned, obviously, about the clear slowing in the economy, at least for now, I guess I do think that the concern that most of the members undoubtedly have is probably tempered by the fact that we know that at least some of this is temporary. The run-up in fuel prices has undoubtedly put a drag on consumer spending and consumer confidence. The situation in Japan has undoubtedly had a negative impact on U.S. industrial activity. So I expect many of the members are now looking at that carefully, and the question is this going to be a temporary, transitory thing, or is it going to persist? And I think they feel we can sit tight for now until we have a clearer answer to that question. But they'll be watching it going forward to see whether this thing is going to be longer lasting. And then, if it is, then they'll have to consider whether they need to take some further action.
Is it 50-50 on further action in your view right now?
I would say, I think, Frank, my own view, for what it's worth, is that these are mainly temporary things and that the economy, well, I certainly don't expect a sharp upturn in the third quarter. I think things will improve in the next couple of months. And in that event, the Fed would not need to take further action. And I think that's larger than a 50% chance. I would put about a 75% probability on that. But again, that's, in many ways just a guess. We're going to have to see. So signs in the future, they're going to be looking at consumer spending. I think the next job number, obviously the number for June, which will be released the first Friday in July, will be a key indicator. If that's another weak number, that's going to put a different shade on this. If it's a better number, then that'll give more comfort.
Al, I want to remind everybody of some of what we got from Ben Bernanke this week, because earlier we did hear from the Fed chairman. He spoke to a group of international bankers. Here's what he had to kind of say about current Fed policy. So listen up, everyone.
Although it is moving in the right direction, the economy is still producing at levels well below its potential. Consequently, accommodative monetary policies are still needed. Until we see a sustained period of stronger job creation, we cannot consider the recovery to be truly established.
Al, I wanted to play that for everybody again. I wanted to play it for you as well, because I'm just curious, do you get any indications that we've got a frustrated Fed chairman, a frustrated Fed at this point?
Well, he's a pretty experienced pro, Carol, but I'm sure that he is frustrated and disappointed that the actions that have been taken so far have not gotten more of a response from the economy, although, of course, we've succeeded in keeping it from getting any worse. When he says we still need an accommodative policy, what that means to me is we don't begin to tighten yet. Leave it where it is now. I don't think it means, just on the basis of what he said, that they need to take further action yet. That will depend on what happens going forward.
Well, that's interesting that you say that, because we talked with a billionaire investor, Jim Rogers. He was on Bloomberg TV earlier today. He argued for the Fed to raise rates right now. I want everyone to listen up to that one as well.
Let the interest rates go to where they should be. I would stop propping up false interest rates. In this country, we are really abusing the people who've saved and their money and put it aside. Okay. They're now earning zero. The people who did everything right are being abused, and the people who did everything wrong are being saved.
Is that the definition?
What kind of country is that?
All right. So, Al, Jim is never bashful. He's always outspoken. But is he right? I mean, should we let interest rates just go where they may at this point, or we cannot afford to do that because it would harm the economy, in your view?
I would say the latter. At some point, obviously, rates are going to have to rise for macroeconomic policy reasons, and that could conceivably, well, I don't think it's likely to come in the next several months, but it will come at some point. But at this stage of the game, with the economy clearly pretty fragile, with the job market still very weak, with no real signs of an increase, Carol, in permanent underlying inflation. Yeah, I know the latest overall headline numbers have been up because of but that's all, as Bernanke, as the chairman laid out very clearly with some numbers in his speech at midweek, almost all of that, if not all of that, increase is over the underlying trend is clearly the result of the increasing commodity prices. So you don't want to react to that if it's transitory.
If it's transitory. But, you know, I got to tell you, it impacts our pocketbooks, Al. We all talk about it, filling up at the gas station right now. I mean, it hits our bottom lines. It means maybe we're not spending more on other things, and that obviously filters through the rest of the economy. I mean, it does have an impact, though.
Absolutely it does. And that's what, when I say the economy is fragile, that's one of the reasons. You know, people are not sure that these prices are going to come back down, although they are beginning to do that. So it's in that environment. I think your point is well taken, Carol. It's in that environment that it would be, I think, premature for the Fed to move yet. But obviously, if we, as we go forward, if you begin to see more growth, but more importantly, if you begin to see something like the core inflation rate, the underlying inflation rate, begin to creep up, then the Fed is going to have to be ready to change its mindset and move in the other direction. No question about that. This is just a very dicey period, and the Fed has to, its actions have to be largely data-driven. It's hard to get a very clear read now on exactly where we're headed. You make your best guess, you make your best judgment, and go with it, looking at all of the numbers they have. I think the comforting thing is to make one other brief comment. Nobody looks at these numbers and gets to read any more clearly than the Fed and its staff. They've got a great team, not only in Washington, but across the country at the reserve banks to do that. And I have a lot of confidence, despite the challenges ahead, that they'll get through this and do a good job.
Well, Fed, or Al, let me jump in here. It's Adam Johnson down on the floor of the exchange. Let me give you the perspective from the traders down here. Talking to three guys today, all sitting on 80% cash. Between them, they manage well over $1 billion. They say there's no plan right now. There's no plan in place that I can get behind and get excited about. And until I get some sort of plan, I'm going to sit on the cash. I'm not going to deploy it. So the question becomes, where does the leadership come from? Is it political? Is it from Bernanke? Where does the leadership come from that gives us a coherent plan for a way out, a way to grow GDP, a way to get people back to work? Where's the plan coming from?
Fair question, Adam. I would do this. Let's make a distinction between fiscal policy and monetary policy. I think the plan has to come on the fiscal side. That's where the real lack of clarity is. And Bernanke made this point in his speech. We need a longer-term, clear plan and strategy, and it has to come ultimately from the Congress and the president about how we're going to get out of this fiscal situation, get our debt level under control, and deal with that whole problem. And of course, in the short run, we got this debt ceiling issue to deal with. We need a plan there. If we could get something that was coherent and credible, I think that would have a hugely beneficial effect on the economy, on financial markets, and on the stock market. Monetary policy does have a plan and a strategy. The objective is price stability and financial stability. And I think, you know, we have to react to bits and pieces of short-run data to try to get some sense of how the economy is moving so we can have the best settings. But the strategy is in place. I know that some people are confused and maybe have some doubts about whether the Fed has a clear view. But my own view from my experience in the Fed and as an economist is that it is a clear view, a clear objective, and all we need to do is stick with it. On the monetary side, I think we're safe. It's on the fiscal side you need to fix.
Al, you know, one thing I want to ask you is, I'm thinking about the market environment. I know the Fed doesn't focus supposedly on the financial markets. That's not their mandate. But we're down 6 weeks in a row here on the S&P 500. Folks are talking about a correction. They're pretty nervous. They're pretty upset. So we're seeing investors certainly bail out of the equity trade. Commodities have come down as well. How much, you've been inside the Fed, how much does the Fed kind of keep a little bit of a watch on what's going on in the financial markets?
It certainly watches financial markets. Of course, it depends on the market. Obviously, we watch credit markets and interest rate behavior in the Treasury market very, very carefully because we operate through that market. As far as the stock market is concerned, if that may be where you're focusing, Carol, we're always aware of what's happening in the stock market. But I would say the short answer would be not a whole lot on a day-to-day basis. We expect volatility and more these days than when I was there in the stock market. What you want to know is if a movement in the stock market contains information, macroeconomic information about the broader economy and attitudes that the Fed needs to be aware of and focus on, then we obviously have to do that. But not a lot of short-run focus on the stock market. Now, if you have, to take the current context, if this decline in stock prices were to persist and become significantly deeper, then I think that would be a signal to the Fed that the overall economy is even more fragile and weaker than, I'm not forecasting this, but just hypothetically, if that happened, then that would be something the Fed would give attention to. But not yet. I don't think we're at that point yet.
Hey, listen, with housing and unemployment, you know, we've had a lot of people also come on and say housing took a big hit. Unemployment or employment took a big hit. It's going to take a while. We understand it's going to take a while to get back to normal or so-called normal levels. How much of that discussion goes on in the Fed that they're saying, hey, this is just going to take time? There isn't much more that we can do to kind of help these two sectors, two very key sectors, of course, to the economy.
You know, you have different views, obviously, among different people inside the Fed, but I think a large number of Fed people recognize that adjustments in the macroeconomy often take time, and what's really required is some patience. And often what you need to do is not just do something, but stand there and not get in the way and let the normal healing process work. One of the advantages of the degree of independence from the normal political process that you have in the Fed is that you have the luxury of doing that. And obviously, you know, politicians need to react to what the people are saying and what seems to be happening immediately in the economy. But it's also important to have a significant government agency like the Fed able to take a longer view, a more patient view. And I think we're aware of that opportunity and try to use it.
We got to run. Al, always good to get some time with you. Thank you so much. Have a great weekend. Al Broaddus,
You too,
former
Carol.
Richmond Fed president.